Well, good morning, ladies and gentlemen. Thank you very much, Bob. It's a great privilege and pleasure to be here. I'm going to break the first rule of public speaking by starting with an apology. Somehow or other, over the last week or so, I've acquired this head cold, which probably means I'm going to burst out into a coughing fit shortly. So I apologize in advance. My other apology, of course, is that I've listened very carefully to what happened here yesterday, and I thought this was a particularly buoyant, a particularly forward-looking and positive organization, that people felt that there was a real sense of purpose in the future. I'm going to talk about a number of things that might throw some cold water on some of that. In fact, we started to get that impression, I think, by the last presentation yesterday, where very clearly we were being told that we were using our resources faster than we could replace them. I'm going to talk about some things like that. So please take this in perspective. My sense is that if we don't attempt to understand the future, and we will never understand the future, we will never get the future right, but if we don't attempt to understand it, we'll be even more surprised when we get to the future, and it'll be even more difficult to deal with it. Let me start by just saying a little bit about my organization. It's 11 years old. It was formed in Perth by Sir Giles Court, who was then the Premier, and Michael Jeffrey when he had finished as State Governor. Michael, of course, would shortly become the Governor-General. He's an old friend and somehow or other cajoled me into taking on this responsibility. It's a not-for-profit organization. I tell people that the 20 richest people in Australia support us, 18 of whom at least are absolute misers, and I've yet to meet the other 2. Not unusual. We have 4 major areas of research, and I'll just talk very, very briefly about each of these. The first, of course, is to look at the opportunities and challenges which face us in the Indian Ocean littoral. As a nation, we don't pay very much attention to the West. Indeed, I tell people in Perth that my organization has 2 roles. The first, of course, is to try to convince Australians that they're part of a 2-ocean continent. That goes over very well in Perth. And the second is that West Australians need to wake up to themselves and realize that they're part of a dynamic nation in a changing part of the world. That doesn't go over quite so well. But looking at the Indian Ocean littoral is a difficult challenge. The Indian Ocean, of course, is a geographic area. It's not a political entity. I suspect those people who work in the African Union could not care less about ASEAN and vice versa. But I'm also appalled by the lack of knowledge and understanding that we have of the subcontinent, in particular India. I think I've attended a number of foreign policy meetings in Canberra, and I have to say that the senior policy officer responsible for Indian Ocean policies, for policies in India, has spent probably the best part of the last 6 months doing nothing else but attempt to develop policies to ameliorate that bad situation that occurred between Indian students in Australia, and certainly the situation as it was shown in the Indian media. So our knowledge about India, our future understanding of where that country is going, is quite abysmal, and that's something I hope that we can address. Australia's energy security, we did some work on this last year. Essentially, I was trying to determine what energy requirements we had as a nation till 2030 and how we might meet those energy requirements. But a lot of people are doing that, and it's an area that I'm not particularly involved with right now. Future directions for Northern Australia, again, my intention had been that we would look at the littoral states, everything through the Indonesian archipelago to Melanesia, and try to make judgments about what was happening there, what impact that could have on Northern Australia. But increasingly, I find that I've been brought back into Northern Australia. And what we're really looking at now is the future of Northern Australia. Out to 2020, all our work is futuristic, and try to make judgments about how important this region will be in our national psyche, on our national economy. And I'm just not looking at the minerals and energy sectors, but food and the agricultural and pastoral sectors, fisheries, tourism, water, innovation, and so on. And while there's a lot of study being done on this area, not much of it is being done looking too far forward, and I think much of what is being done is very much silo-looking. It tends to be in narrow focuses, and you've got different parts of it, even a state government looking at the area from different perspectives, and no one's brought it fully together. And that's something we're certainly attempting to do. And the last issue is one which I'm going to spend most of this morning, or most of my time, talking about, and that's to look at whether we have a future global food and water crisis. And if we do, what shape it will take, how it will evolve, what impact it will have on Australia, and what we as a nation can do about it. And I'm convinced, ladies and gentlemen, and I'm certainly an optimist in most things, that we face potentially a catastrophic issue globally sometime towards the end of the next generation, somewhere between 2030 and 2040. And that's the issue I would like to talk about this morning. So, ladies and gentlemen, as you can tell, I'm talking very much about the future. This is not an easy issue to do. I think that perhaps once upon a time we attempted to look at the future, perhaps a generation ago, but certainly today, at government level at least, federal and state, there's really no appetite about the future. In fact, I think we tend to deal with today's problems today. We don't attempt to anticipate what they will mean and prepare for them. And I blame a lot of that, quite frankly, on the information age. The information age, as you know, was there to liberate us. It was to give us an opportunity to understand why things occurred the way they did, why people took the decisions they did, why policies were made on our behalf, and so on. And of course, by understanding all of that, we would be in a far better position to be able to influence those outcomes. But has it done that? Certainly there's far more information out there than we've ever had before. A good deal of it is contradictory, some of it is propaganda or disinformation, and some of it is quite wrong. But I think that certainly from an information access point of view, we're probably far richer in that area than we were in the past. But are we any the wiser? Are we any happier? And I suspect the answer probably is not so. And of course we need to ask ourselves why that is the case. We of course live in the age of spin. I sat here all day yesterday and I heard a fair bit of spin yesterday. Not surprising. Every organization now has an element of spin to it. What is spin? Spin is taking the truth and presenting it in such a way that it emphasizes certain points of view, or it attempts to guide people in a certain direction. It's not always the actual truth. And of course, one of the challenges that we do have is to determine what actually is the truth. The media, of course, follows its own line of reasoning. It concentrates on immediate and topical issues, at least most of the popular press does. These are selectively chosen for their sensationalist reporting and appeal, and this in turn can lead to confusion and uncertainty. From my perspective, the media has little appetite in writing about the future. Nor is it helpful that much of what academics and scientists do remains within their journals, and no one has access to it. Indeed, it's also, I think, somewhat frustrating to see where 10 scientists, for instance, have made a particular point. I'm thinking about climate change, for instance. They will get those 10 scientists with all their learned work, all their experimentation and research, will get less publicity than one person who comes out of the blue and says it's all wrong. That doesn't help, in fact, when it comes to trying to understand things. Of course, in the information age, we have many conflicting viewpoints. And this in itself can be a challenge. Policymakers and those who have to make decisions rapidly and quickly very often need to have black or white information. Grey does not help. And very often, if they don't make a decision in a timely fashion, because they're uncertain, they will be criticized. We also have the situation where throughout the ages, prophets have come forward and have appeared to make a very plausible case for something and were subsequently proven wrong. Malthus in the 1800s, the early 1800s, claimed that we would exceed, when we exceeded a population of 2 billion people, the world would be unable to handle that population. All of us, of course, remember Paul Ehrlich. I think he was speaking probably 20 or 30 years ago, making similar sorts of predictions, certainly at a higher level. And we now have to ask ourselves whether the statements that Al Gore is making about climate change, in fact, are going to have the same outcome. And finally, ladies and gentlemen, we confront the age-old problem of psychological avoidance. We've always had this. In other words, if the issue is too difficult or too complex or too mind-shattering to deal with, let's find some way of not dealing with it. Let's hand it on to another generation. Let some other organization take it over. Or let's listen to the facts and the information that suggest it may not happen. And we've always had that issue. So as you can tell, ladies and gentlemen, it's extraordinarily difficult to deal with the future. When I headed our Defence Intelligence Organisation, which was arguably the largest research institute in Australia, some 350 analysts, I was constantly frustrated by the fact that we couldn't predict anything about the future. Certainly not to the extent where we could get policymakers to change some policy in regards to that issue. I used to do a lot of public speaking to people who received our product, and I would start by saying, think back 5 years. 5 years, of course, took us into the late 1980s. Who amongst us could have forecast the fall of the Soviet Union, the collapse of the Russian Empire, the fall of the Berlin Wall, the fact that Yasser Arafat would be in Jericho, or Mandela running South Africa, or that the LDP would no longer be in charge of Japan, or that the British government would talk to Sinn Féin. Nobody, to my knowledge, predicted all of those, and very few people predicted any of them. There were two stories that came out of that. I knew my word was getting around because I attended a lunch meeting somewhere in Canberra, which was being addressed by the then doyen of public servants, a man called Tony Ayres. Tony had been the secretary of one department or another for about 20 years. He was a tall, bluff sort of man, dominated his surroundings, and he went through exactly the same litany that I've given you. But he added one more fact, and that was that Queensland would win the Sheffield Shield. I remember someone else coming up to me after one of those sort of meetings and poking me in the chest and saying, you know, you really shouldn't talk the way you do. You've got it completely wrong. I predicted the collapse of the Soviet Union. You need to read my book. I knew this fellow and I knew he'd written this book, and I said to him, yes, Paul, I'll read your book, and the next time I'm flying somewhere, I'll take it. Well, I did a few months later. He didn't quite predict the collapse of the Soviet Union the way he intimated, but what was more, he predicted 4 other things, none of which came about. So you can see talking about the future is always going to be a challenge. What I'd like to do right now, and I realize that time, of course, is always short, is to talk a little bit about the global food and water crisis, which I think is going to emerge and which I think has got the potential to be a catastrophic global issue, probably within a generation, 2025, 2035, that sort of period. 50 years ago, the world had fewer than half as many people as it has today. They were not as wealthy. They consumed fewer calories. They ate less meat. They required less water to produce their food. The pressure they inflicted on the environment was lower. And indeed, they took from our rivers a third of what we take today. The world population has shot up. In 1800, when Malthus was around, it was 800 million. Today, it's about 7 billion. And it's expected to peak later this century, but by 2050, it probably will be in the order of somewhere between 9 and 11 billion people. And much of that increase will occur in areas that can ill afford to have that population. I think it's also significant to show how in the wealthier part of the globe, the Western economies at least, how our salaries have increased. And in that period, from Malthus till today, they've probably increased 100-fold. In 1800, the average salary was probably the equivalent of about $400. Today it's $40,000, and that in itself has had an impact on what we do. If we'd been having this meeting 6 weeks ago, I think all of us would have been very much taken by what was happening in the Middle East. The problems that started in Morocco and spread very rapidly to Egypt, and of course today continue in various parts of the Middle East, including Yemen and Syria. And what started that was in fact a rise in food prices. This is an extraordinary issue, particularly when so much of the population is on a starvation limit anyway. And of course, the Middle East issue was very rapidly consumed by other aspects, poverty, a lack of employment, unpopular government processes, and so on. But the bottom line was that what started that process was, in fact, the rise in food prices. The Rome-based Food and Agricultural Organization has a food price index. They believe that food prices peaked last December, and their index showed that to be at 215 points. The previous month, it had been 206 points. And to give you some idea of how quickly food prices have gone up, in 2000, it was at 91 points, and it didn't get past 100 until 2004. Expressed differently, between 2006 and 2008, the price of rice rose by 217%, and that of wheat by 136%. Those are staple crops and very much part of the main food source for many people. Why has this happened? Of course, we've had food price rises before. You may remember in 2008, we went through a similar sort of process. Indeed, there were riots and demonstrations in at least 30 countries at that time. But then the financial and economic crisis put an abrupt end to price rises. I don't think the current situation is going to be so short-lived. In the past, it was generally adverse weather conditions that brought about an increase in commodity prices. But now I think there are both supply and demand factors. On the demand side, certainly the population growth, rising affluence, and the fact that grains are used to fuel cars in many parts of the world are all significant contributors. On the supply side, there are many causes: soil degradation, aquifer, artesian water depletion, the loss of farmland to non-agricultural and pastoral purposes, increased urbanization, and the peaking of output from a number of advanced agricultural countries. Nor can we ignore the long and often debated issue of climate change, with crop-destroying heat waves, inundated farmland, and melting glaciers. It's an issue we need to continue watching. Some analysts, of course, say that there's a glimmer of hope. They say that the increase in population has slowed down considerably. And certainly in 1970, we would say that the average annual increase was about 2%. Today, it's probably about 1.2%. And sometime later this century, probably after about 2050, it will peak out. And then we'll have another problem. We'll have a declining population which is rapidly aging. It's also said that between now and 2050, some 3 billion people will in fact go up into the so-called middle classes. A lot of these people, of course, will come from Asia. Asia today, the bulk of people live in poverty and rural circumstances. But the rise of the middle class in India and China has been quite dramatic. Of course, it remains to be seen whether that will continue. And the third major reason put forward is the fact that grain is often used to fuel cars. In 2009, for instance, the United States used nearly a quarter of its grain product to develop ethanol, a product that would have fed about 350 million people. On the supply side, we have large areas of farmland which every year are in fact suffering severe and irreplaceable soil erosion, poor farming practices and urbanization. It's estimated that a third of the world's agricultural land is losing its topsoil faster than it can replace it. 2 huge dust bowls are developing, one in northwest China, in Mongolia and Central Asia, and the other one in Central Africa. And these dust bowls, in fact, with ever-increasing frequency, are creating huge dust storms, which are resulting in literally millions of tons of topsoil disappearing. It's been said that in China alone, some 24,000 villages have either been abandoned or at least largely abandoned as a result of this process. The bottom line, ladies and gentlemen, is that we're running out of high-quality soil. The availability of such land has declined from 0.45 of a hectare per person in the 1960s to about 0.25 of a hectare today, almost half, and it's thought that by, again, 2050, it's going to decline to about 0.18 of a hectare. Aquifer depletion. In Australia, of course, we have huge artesian water supplies. We see artesian bores drying up from place to place, but nevertheless, on a national basis, we've probably got enough water to supply us for the next 2,500 years. But in certain parts of the world, that water is rapidly drying up and not being replaced. It's occurring in western United States. A very significant issue there. In the Middle East, and in particular in China and India. It's estimated that in India, something like 150 million Indians, farmers, will be forced to leave their land by 2030. Where will they go? They'll go to the increasingly growing and expanding cities, to the slum areas that, of course, encircle all Indian cities, and they will add to that. In China, the North China Plain, which is the breadbasket for China, where probably about 70% of China's agricultural product comes from, the aquifers there are 30% of what they were in 1950, and that water is declining. Now, the Chinese, of course, are taking all sorts of steps to try and replace that. They're moving water by pipeline. There's talk about large desalination plants, about improving the economy and the use of water, attempting to capture water that runs out through their urban areas, and so on. Whether, of course, they can do that quickly enough to keep up with the demand against the decline remains to be seen. There are other issues, of course, apart from the availability of water. Contamination will be a major factor. And I think it's probably fair to say that in the last 4 decades, the amount of water that is available has shrunk by about 2/3. And this is expected to halve again by 2025. You may well ask whether we're past peak water. Of course, ladies and gentlemen, I've not mentioned poor farming and inadequate management, ineffective infrastructure, dams, pipes, channels, and water storage, land that's overgrazed and that is rapidly turning into desert, salt and acidity, and of course we have the issue of climate change. Fast-growing cities are also competing with farmers for water. This outcome, of course, is being seen very clearly in places like Egypt and Pakistan, India and China. Many of these new city dwellers are former farmers who are now demanding food. Such urbanization leads to greater politicization as well. People who come to the cities are likely to be more vocally, politically, and more demanding in political terms. more quickly mobilized to demonstrations and so on. The prospects, ladies and gentlemen, for the future in all these areas are not good. Global output for cereals, including rice and wheat, are likely to fall by 1.4% this year, while the demand is likely to increase by 1.8%, and that's just over the next 12 months. Ladies and gentlemen, let me just finish by saying a few words about two nations that we in particular need to consider very carefully, China and India. I've been very impressed by the fact that we tend to see China as a long-term market, a viable market, and one, of course, which will consume many of our exports. That remains to be seen. The Chinese themselves are very much aware of these issues. They don't make them public, but are very conscious of the fact that they have got a number of political and financial imbalances in their population and economy. We heard yesterday, for instance, that there's a major inflationary issue in China. Certainly the wages have increased in southern China by something like 30% over the last 2 or 3 years. Why? Because China has a labor shortage, and an impending labor shortage that is going to be extraordinarily significant. There's one statistic, all in the 30s, which I think says a lot. By 2030, it's expected that 30% of Chinese males will not have a bride. This is very much an outcome of the one-child policy. And the problem will be exacerbated because the richer, coastal-based Chinese will go inland to find their bride. We also hear stories about the aging Japanese population. Sometime in the next 15 years or so, 25% of Japan's population will be too old to work. At the same time that happens, the equivalent percentage in China will be 30%. And China does not have an old age pension policy. It has a very primitive rural medical system. And many of the more youthful Chinese, the generation X and Y, will in fact have left the rural area to go and work in the manufacturing sector. How is China going to work through that? That remains to be seen. And of course, I've mentioned very briefly the Chinese problems with their food and water, and they're trying very hard to do things about that. And of course, the Chinese environment itself has been damaged significantly in the past. The other issue, of course, is India. And India is an extraordinarily interesting country, and it has great potential, but it also has great challenges. And in very recent times, last week, I had breakfast with our High Commissioner in India, and the week before that, believe it or not, a group of about 6 of us had breakfast with the Indian Minister for Commerce and Industry. I asked him about his water issues. He said, oh yes, we've got problems there, but we've got to fix it. We're going to spend a lot of money on it. And I said, how are you going to fix it? Oh, we've got scientists looking at that. Didn't give me a great deal of confidence or hope. In fact, I suspect it was the first time he'd even thought about it in the 2 weeks that he'd been in Australia. And as I said before, it's estimated that the aquifers in India, which are now down in many cases well below the levels that farmers can extract them, are going to continue drying up, and that many Indian farmers will need to go to the cities. Now, we talk about our own population policies, which we don't have. But one thing that would not surprise me is that if we think we've got problems today with illegal immigrants coming by leaky boats to this country, illegal immigrants that would roughly fill about a quarter of an average stadium a year, think about 2030, when literally millions of Indian peasants, today's Indian illiteracy rates are 400 million are illiterate, will descend upon the cities. They won't come here. They won't be able to afford it. But the rising Indian middle class might, because they will be looking for somewhere to go. They can go to Europe, perhaps, unlikely. They can go to the United States, perhaps, unlikely. They're certainly not going to go to the Middle East. They're certainly not going to go to Southeast Asia. Where else could they come? Where is there a significant Indian diaspora today that knows about the living standards of a certain country? It's here. We need a population policy that addresses that issue, I would think. So, ladies and gentlemen, I've left you with a number of issues there. There are answers to many of these things. The answers require a great deal of research and development. They require, above all else, a commitment by governments at all levels and private enterprise to spend more time thinking about these issues, to try to identify means of alleviating what I think for our children and our children's children will be an extraordinarily significant issue. Thank you very much for your time.
Thank you very much, John, for sharing those insights into future issues. It was a great event for us to listen to that. Coming up next, we have an address from Ernst & Young's. But just before we go into that, just to remind delegates that the Sorrents workshop begins at 9:45 for any of those that are involved. So the next keynote address is shared between Sean von der Linden and Angus Blackburn, both from Ernst & Young. Sean is a tax partner and a leader of the South Australian mining practices for Ernst & Young, and Angus is a transactions partner with significant experience in the mining sector. They're going to give us a combined look at what's happening in the mining sector.
Thanks, Bob.
Thank you very much.
Good morning, everybody, and I hope you all enjoyed last night's function. I certainly did. I had a good win on Winning Wendy. Unfortunately, I did my dough on Climbers Prick. No truth to the rumour, got beaten by a short head, I think, but and I hear a lot of you partied on at the West Darling Hotel, so hopefully I can entertain you this morning to talk to you about two areas that Sean and I have seen some developing commercial trends on in the mining sector. Firstly, we wanted to talk about infrastructure, and in particular common user infrastructure, and some models that we're seeing being developed which may be of use to you in your planning. And secondly, Sean will then focus more around the current status around the MRRT, PRRT tax issue and looking at ways to plan for that. So our discussion's not designed to be terribly technical, but rather just to be informative around areas which may help you to plan on over the next 12 months or so as these issues develop. So the agenda we want to go through today is, firstly, we'll touch on the infrastructure challenge that it's facing, and by that we mean beyond the mine gate. We're talking very much around some of the infrastructure corridors that are vital for you to get your product to market. And there are some examples, probably particularly in this region, where there are some solutions required to get that infrastructure corridor developed in a way which expedites that getting that product to the market. Sean will also touch upon some of the measures recently announced in the federal budget to try and encourage greater involvement from other infrastructure owners in helping to develop infrastructure generally and how that might relate to the mining sector. And then we'll talk about some findings that we've had in developing solutions for other clients, namely up in Queensland around some common user facilities. And some of these findings are still working their way through, and there are some barriers that we're having to overcome, but hopefully we'll be able to explain what they are and help to plan for those in your own thinking. And then Sean will then address some of the action plans and matters that we're addressing around getting ready for the MRRT introduction, which is not too far away potentially. So, and like John, I'll give you a brief apology. Sean and I put these slides together. We didn't have much marketing flourish in them, so forgive us if they're not as spectacular as some of our predecessors. But the infrastructure challenge I think we've got in Australia, and certainly in the region here in Western New South Wales and in South Australia, is been articulated in a number of reports over the last couple of years. Firstly, we've had the Vision 2020 report from the Minerals Council, which looked at various regions, I think about 21 regions around the country that focus on the mineral sector, and articulated what level of infrastructure needed to be developed in those particular areas, from both the economic sense of roads, rail, port, energies, etc., to social and in particular accommodation. And looking at the region that where I guess a number of you are focusing on, not all of you I appreciate, but a number of you are focusing on here, and very much all categories of infrastructure were identified as being needed to be developed to try to add value to the sector in this region, particularly around rail, ports, airports to fly in and fly out people in the northern parts of South Australia, and also a looming energy issue that's, I guess, going to challenge the entire country with a lack of investment at the moment in such areas as transmission networks and generation capacity. In the Infrastructure Australia priority list, which was issued in June of last year, if you tally up, I guess, the $83 billion worth of projects there, about 18 billion, or just over 20%, focus on the mining sector, which is probably not a bad representation. But when we come to this particular region, there's only probably, you could argue, about $500 million worth of projects. So the trend is that for certain areas of the country that focus on mineral sector, there may well need to be some further, more innovative thought around how we do solve the infrastructure corridor solutions. The other challenge, of course, is that we're all probably aware of and have heard a bit about over the last couple of years, is that the fiscal position of the state governments is becoming increasingly challenged. We've seen Queensland go from a AAA rating that seemed to be, entrenched there over the past decade or so to a AA credit rating, and certainly a number of the other state governments are really focusing on trying to maintain that AAA credit rating. And the casualties we've seen right across, not just in the mining sector, but in a number of different sectors as well, has been some infrastructure projects have had to be put on the back burner. So the ability for the state governments to act as a circuit breaker in some of these issues has been somewhat limited. They're still very keen to provide policy and regulatory settings which support other investment, but just in terms of their capacity at the moment, that's somewhat limited. So what we've seen in the past couple of years, I guess, is that some of the more traditional solutions around infrastructure corridors have met their own challenges, and they're now forcing, I guess, the issue back to the private sector to look at various solutions. Now, there are other models around the country of what we call common user funding, and they are principally in areas with organisations that have large balance sheets, such as the Pilbara and also the Newcastle Coal Group. But there are some areas up in Queensland, and we're working with a consortium of small to mid-sized miners at the moment to try and develop a solution to some rail enhancements that need to be attached to the new Wiggins Island coal export terminal just off the coast of Gladstone. And that's quite a complex set of negotiations, but hopefully we can share some ideas around that with you today. I think that one of the key thoughts that we want to leave with you, and will be a theme throughout the presentation, is that in your planning around not only the mining, there now needs to be almost a broader set of thought processes going on in engagement, like I think we see today or earlier in this week with the announcement of the Braemar Iron Alliance. And that was around very much to try to get a group of people with a regional alignment into trying to solve a common infrastructure problem. And that may be a development or a model in the future. Oh, sorry. So I'll just ask Sean just for briefly to step up and just talk about the federal infrastructure measures in the budget, and then I'll take back over and talk more about some of the common user funding models.
Thanks, Angus. We're going to tag team a little bit this morning just to keep you interested for those who are still struggling after last night. I guess in that environment you might think that the federal government would be looking to encourage and sponsor infrastructure investment as much as possible. And it's good to see there are some of those funding opportunities available there amongst the 83 billion or so that Angus discussed. Unfortunately, the federal budget this year was pretty disappointing in terms of measures that might support infrastructure. Maybe the government's got a little bit on its mind in terms of some other measures that are out there at the moment. But really all we had was some fairly minor announcements around some further funding for Infrastructure Australia. And we're talking just about funding for Infrastructure Australia to organise itself, so in the sort of 30 million range. As well as an announcement around the ability for Infrastructure Australia to designate certain projects which are seen to be of national significance. And if these projects are designated in that way, then they can get some enhanced tax treatment. Now, it seems to me on reading the very brief announcement that came out with the budget that most of these nationally significant projects that Infrastructure Australia is looking at are more sort of the state government-sponsored PPP type projects. But I would hope that when we think about projects of national significance, you certainly would think of the minerals industry and the resource industry and the need to get the product to market through various transport corridors and such, as well as power, water, etc. So there is a process over the next year or so of working out how the decisions are going to be made around these nationally significant designated projects. If a project is designated in this way, then what it means is that early year losses, which quite often you can get in these projects, can be indexed to the CPI, so that the losses you actually get to utilise later on once the project starts to earn income will be enhanced. And secondly, often what happens with infrastructure projects is you have a development phase and then an operating phase. And also quite often you might see a change in ownership in the project between the development phase and the operating phase, so that under the current tax rules, if you have losses at that point, those losses might be cancelled and not able to be used later on. And so these measures are going to protect those losses for certain designated projects. So it remains to be seen, I guess, how significant this is, but it's certainly, one move in the right direction. One of the ideas is that this will enable superannuation fund investment to go into infrastructure projects. There's sort of a holy grail out there that we've got trillions of dollars in the superannuation fund industry. How can we get that into fund infrastructure that's necessary for the future economic development of the country? And the idea perhaps behind these budget measures is that that will enhance the ability of super funds to not necessarily invest in the development phase of infrastructure projects, but maybe to invest in that later operating phase, and for those sort of changes in ownership to not be a problem for the project. So sort of a minor measure in the budget. Hopefully we'll see more in future from the federal government. Thanks, Angus.
Thanks. Thanks, Sean. Well, I guess it's a step in the right direction, because I think in introducing other ownership models and other balance sheets into this particular challenge is very important and needs to be supported by both federal and state governments. So how do we meet this challenge? I think that obviously we need to continue to have the government support, at least at a policy level. But I think the other broader challenge for us all is how do we communicate as an industry together to coordinate some solutions to these particular corridors. And if I can use a practical example, it's the issue around a deep water port in South Australia, which has been talked about for several years now as a very important release mechanism for some of the mining precincts, both from the Eyre Peninsula all the way around to the Coober Pedy and to the Curnamona province. Is an important area to release bulks through a deep water facility. A number of juniors in the iron ore industry, I think over the last few years, have found it challenging to raise capital on the back of not having a viable infrastructure solution. And then we look at the ones that have been talked about. We've got obviously the Port Bonython project that was sort of put up by the state government. We've got Sheeps Hill that's been proposed by Centrex. We've got discussions, I think, more recently about Ironclad's floating harbour. There are discussions around barging some of this product from Port Pirie out to Cape-sized vessels in the Spencer Gulf, and more recently maybe some further developments on the eastern, further south of Port Pirie on the eastern Spencer Gulf area. There's 5 different ideas trying to solve this one particular problem, and some of them are generated by governments, some are generated by infrastructure owners, some are generated by mine operators, some are generated by a group of mine operators. So it's a matter of, I guess, trying to coordinate that approach amongst the sector to provide a solution that fits best for the whole region, which is not an easy issue to do. But so the 4 broad opportunities that exist, I think, for the sector are firstly to engage as a user group in the region that's relevant which has common interests about developing infrastructure corridors. Then to have an early engagement with the government and regulators, because where that fits in is it might well be that the policy outcomes or the regulatory settings need to be adjusted to enable that project to get up, or that project structure to get up in the way that will be the easiest to attract capital to that project. And I'll go through a bit of a model in a second about how something like that might look. But if you get the wrong regulatory settings, well, that could destroy the investment potential of a project. So getting on the front foot and massaging that early is important. Then in terms of structuring of projects and the analysis, this may take further and deeper analysis just beyond the mine gate to be done earlier on to start engaging with these organisations. And it also, fourthly, may roll through to starting to think about any partners that you're taking on. What is their ability and what is their capacity to help you in developing an infrastructure corridor, either through their own skills and their own IP, or their balance sheet that they can help you provide access with to raise funds through project financing arrangement. So common user funding, for the avoidance of doubt, effectively it's a group of people who get together with a common interest to provide equity into a project to fund a piece of infrastructure. So if we're talking about a port, for example, there could be 5, 6, 7 mining companies who provide the equity to support a project financing debt levels to enable the port to be operated, so it's to be developed and then ultimately operated. And there are various options as to how long the operators or the users will remain as equity holders. They could stay in for the long haul, or they could just quickly turn that over and sell it to an infrastructure owner so that they can release capital to their balance sheet. The major challenge, of course, is the operation of an infrastructure asset is different to a operation of a mine. So there's different risk parameters, different investment parameters to that. So it's dealing with the blend of that and the greater proportion of that which might impact upon your project. So just quickly going through the key stakeholders and their various issues, and the key stakeholders being, I guess, the resource sector participants, yourselves, the government and infrastructure owners such as super funds or utilities that might come in and play a role. Around resource sectors, I guess the major thing is that they're wanting to see is that the infrastructure is developed and that they have secure access to that infrastructure over the course of their mine life. So the challenges they're trying to overcome is that it's not being developed at all, and when it is, and if they can get it developed, that the structure allows them to have access to get their product to market, and they're not exposed to some aggressive pricing policies which upset the whole feasibility study of their mine in the first place. So they're trying to balance that out with not tying up too much capital, but retaining control over what might be the rail price or the port tonnage price, without the owner, the ultimate owner that they sell this thing to, screwing down on prices that make their project unviable. And they also want to make sure that the government's regulatory decisions around this, around third-party access, etc., also don't upset and give an imbalance to their situation compared to a competitor in the region that may not have taken any risk in this project up front, but through a regulatory decision later on down the track gets to use that infrastructure for a lot less than you, the developer and user of the infrastructure, has been able to use it with. So a number of these questions are very challenging and need to be sorted out up front and need to be addressed with those stakeholders for a resource sector company, I guess, to be comfortable to go forward with a user funding model. On the other side, of course, there's the infrastructure owners that just want to make sure that they generate a long-term return and that they just build capacity into their infrastructure project as and when required. So I guess an example of one of the challenges here has been the Dalrymple Bay Coal Terminal, where we've seen the miners wanting to have an expanded port capacity, but the economics from the terminal operator not meeting that the benchmarks that they want to generate, so that expansion has been slower than some of the miners would have liked. So that has held up created a supply blockage and ultimately have to be solved by developments of new ports up and down the coast of Queensland. But so these are some of the issues or risks that you run if you do develop the model yourself and then sell it off to an infrastructure owner. You need to obviously have some sort of arrangements which allow for the intended expansion of your own capacity is going to be matched by that particular piece of infrastructure also expanding at the same time. And the governments are looking to seeking the development of the sector as a whole and providing access to vital pieces of infrastructure to third parties. And so it's important to understand whether, firstly, you want your asset to fall into a regulatory framework so that ultimately if you do sell it, you're protected by that regulation and that you won't be screwed on prices. Or if you want to just solely have the access to the infrastructure, so it's a piece of rail to yourself and not have to share it with anybody else because your volumes will be sufficient to provide the returns, you may want it in an unregulated environment. And so that's where the engagement with the government will be early and has to be detailed to make sure you understand the risks of that regulation being imposed. I'll just flick forward to a structure here. So this is a fairly basic structure, and it's more or less a project finance structure. So that central box there talks about the special purpose vehicle that would be funding a piece of infrastructure. Say it's a rail line, and then you'll have an external debt provider, normally a project financier, and then you'll have an equity provider. So in this instance, the user equity, so that would be a miner, or you could have a third party adjacent to that, which might be a superannuation fund or a construction company for that matter who wants to get in and operate the asset on a long-term basis. So they provide an equity, the debt's provided, and then the users, being the miners as well, have a separate agreement where they have with this special purpose vehicle that they are then the customer there and pay the charges as normal, and that helps to fund back firstly the project finance and also then ultimately the dividends to the owners. And of course finally there's the construction contract to develop it. Now this is a fairly simple model, and but these models can be become complex when you're dealing where the asset has to sit on a state government-owned piece of land or a state government-owned piece of corridor. So with the Wiggins Island coal terminal, they're trying to develop a rail enhancements sitting on a state government-owned piece of land, and so the complexity is there that how does the financier get security over the property in addition to the cash flows? These are some of the challenges. Now these can be solved through commercial agreement, but the important thing for the project financier, of course, is to have access to the cash flows and have access to a security in the land to provide them with the necessary security to get past their own investment committees. So with respect to those sorts of difficulties, you can see on the right-hand side as you look at it, there is a further level of commercial agreements to involve the infrastructure owner, which is effectively the state government, where they would licence the land to the SPV and then they licence it back to the state government to enable them to enter into the take-or-pay arrangements. But these are through commercial negotiations. These matters can be solved, but they need to be upfront and planned for right from the start. The other critical area around common user funding models is around depending on the credit risk that you're going to be sharing with your other users. So this is where it's important that most of the users have some sort of access to balance sheet, because it can break down, the negotiations can break down if someone's seen to have a really good balance sheet and everybody else has got not such a good balance sheet, then the group can splinter. So when you're forming your group, it's probably an early item to get on the agenda as to what balance sheets are being brought to the party to show that there's some equity in the situation to avoid this whole credit risk type situation. So that diagram just, I guess, helps to depict how the funds will flow. And again, it's very much around ensuring that the funding SPV gets the necessary cash flows through the take-or-pay arrangements from the customers to service the debt levels and then ultimately pay the necessary dividends back to the owners. So it's not conceptually, it's not an overly complicated structure. It's just that sometimes the underlying commercial arrangements around assets and providing the access to the project financier to the security, that's proving to be the most complicated aspect of some of the negotiations that we're currently going through with some of our clients. So before I just hand over to Sean to talk about MRRT, I just wanted to summarise, I guess, in those four areas that we want to focus on is to start broadly engaging, see who's in your area, maybe get some sort of alignment about what you need to develop in terms of infrastructure together. Engage with the government, make a decision as to whether you think it's best that it's going to be a regulated or unregulated asset based on your needs, and to understand what the government's position is. I mean, the government can never guarantee that it won't ultimately be regulated, but it may be able to give you some guidance as to how long it can be unregulated for and how they will treat any application from another party in the meantime in relation to it being regulated. Thirdly, make sure that you build in this concept and plan early around the structure and add it to the development, I guess, of your mining feasibility study as early as possible, so that you can work up a structure that is seen to be a commercial one and a clear one that a project financier and a potential third-party user will be attracted to. And fourthly, I think it's just a matter of ensuring that the planning arrangements going forward in terms of the pieces of infrastructure that you're looking at are articulated clearly to your own investors, because it's important that you get that access to all your partners when you're looking to bring on board strategic partners that they understand, the value that they might be able to bring to this particular conundrum. Thank you, everybody.
Thanks, Angus. So my challenge now is to give you a bit of an update on the status of the mining resource rent taxes in 15 minutes. So hopefully I won't keep you too long and perhaps even allow some time for questions at the end. Against perhaps John's recommendation, I am going to make a prediction of the future, and that is that in 1 year, 1 month and 1 week, these new taxes will start to take effect. So the 1st of July 2012, you may have your own view about the current government and its ability to get legislation through, but the fact is that this is the current government's policy, and it seems to me they do have enough support to get these taxes through the current parliament. And so the reality is that mining and oil and gas companies need to be dealing with these taxes now and thinking about what are some of the actions to take now. There are many things you can leave till later, but there are some things that you need to think about in the short term in order to properly plan for the introduction of these taxes in just over a year. Okay, there we go. So you may have been aware of the various developments in the debate over the last year or so. Obviously, we had the start with the RSPT and the debacle that was, and then the deal between the big three miners and the new Gillard government to moderate the impact of these taxes, limiting them to essentially iron ore and coal, as well as onshore oil and gas projects. And essentially, that's still the current state of play in terms of the breadth of these taxes and the way that they will apply to projects. So we had, at the end of December last year, the Policy Transition Group released its very detailed report into the various recommendations and made a large number of recommendations which provide us with quite an amount of detail about how these taxes are going to apply. And just recently, the federal government endorsed the Policy Transition Group's recommendations, which essentially means that the government's policy now is to really go into an implementation phase. They are working through the Resource Implementation Group to think about the detail and make sure that the way the taxes work on particular projects is effective and consistent. But in terms of the main policy and principles behind the taxes, they're essentially already out there and available for people to work through. There are a number of industry and public sector people on the Resource Tax Implementation Group. Ernst & Young has some representatives on the group as well. They are subject to confidentiality constraints, so if I tell you all the detail, I'm going to have to kill you. But we can't talk too much about the detail of that group. I guess to date what we're seeing is that, as always with the implementation of new taxes, the devil is in the detail. And until we see some of the detailed legislation, the way it impacts particular projects, particular start-up operations, will need to be worked through. But essentially, what we're seeing, particularly with companies that are already in operation, is that there is enough detail out there for them to model and consider the impact of these taxes and to influence their decision-making processes over the next year around expenditure and the starting of projects. So there's enough information for you to, at a fairly detailed level, work through how these taxes will impact your project. Having said that, it is a very challenging time frame. We know from various other areas of tax law development that it takes quite a while to work through the detail and to get the legislation out there. So there will be draft legislation probably before December. It may not be introduced and actually passed through Parliament until sort of shortly before it starts in July 2012, but we will have some detail before then, hopefully. One of the things that companies need to think about is disclosure. And what we're really recommending to companies at the moment is that there probably isn't a need to disclose too much until the law is substantially enacted. And that's when, from an accounting point of view, you need to factor in the tax to your accounts, even if the tax hasn't started to take effect yet. If it does impact the future cash flows from your project, it may impact things like impairment and potentially tax assets and liabilities in your accounts. And that applies from the date the law is substantially enacted through Parliament. So what are we seeing some of our clients think about when they're addressing the potential for these taxes to apply to their iron ore deposits or their coal deposits or their oil and gas projects? It certainly will, you need to think about it when you're looking at and planning expenditures on projects. Does it make a difference if I spend money before the 1st of July 2012 or after? How does that impact the starting base that I can depreciate, or perhaps if I spend the money after the 1st of July, deduct outright against the future tax liability? So some of these things are already impacting decision making. You will have heard about this starting base concept, that in calculating your liability to minerals resource rent tax or petroleum resource rent tax for projects that transition into the new regime on the 1st of July next year, you get to use a starting base. And there's a choice of either book value at the 1st of May 2010, which is when the RSPT was first announced, or market value at that same date. So a practical thing that you could do right now is start to pull together the documentation to support a 1st of May 2010 valuation of your project. That, even if you don't get the valuation done, if you get the documentation in a contemporaneous state at the 1st of May 2010, that will be very helpful for you in future if the tax starts to apply. And obviously, if you're looking to do transactions, whether that be by raising capital or by a divestment or a joint venture arrangement, parties will definitely be thinking about these taxes and what the impact is. And so that really leads companies to think about, have we modelled the impact of these taxes on our project? Do we know what the impact is going to be on future cash flows? Okay, we may think we're going to be under the 50 million threshold and so not pay the tax, at least in the initial phases. But is there still a need to model the impact and think about the impact on NPVs and cash flows from projects? Certainly, I went to the financing workshop and modelling workshop yesterday, and we know that banks, in looking to debt fund projects, are definitely wanting to see MRRT modelled into the models, and obviously has a cash flow impact, so it'll need to be considered. Another thing that companies can think about is whether to get involved in the implementation process. So the government doesn't understand all the detail, and the government doesn't understand exactly how these taxes are going to apply to your project. And the application is different for every project in terms of the timeframes, how the particular detail works around the starting base, how you're going to calculate your taxing point. So the policy is that, for example, with an iron ore project, say hematite or magnetite, that the taxing point is when the ore leaves the run-of-mine stockpile. And so that's fairly early in most of the processing of most of these ores. How do you value the ore at that point? And there isn't necessarily going to be a safe harbour or some legislated, sort of regulated calculation to work that out. You're actually going to need to calculate that differently for each project, and that's one of the really significant and more contentious issues that will need to be worked through. So some of the things to think about: do you want to have an influence on the implementation of this tax and perhaps get involved through your industry bodies or more directly with the implementation groups? Think about the impact on your project, and therefore what are the particular sensitivities? Do the rules look like they're going to work, or are there going to be some anomalies that you perhaps need to flag? One of the really important things is that the way in which both of these new taxes work, both the MRRT and the expanded petroleum resource rent tax for onshore projects, is that they apply to projects. So this means you may have more than one project, or you may have a project in which there are more than one investor. Now, the tax is always paid by the owner of the project, but the tax may need to be calculated more at a project level, and some of the calculations of starting base, expenditure, determining where the taxing point is, will need to be done on a project basis. And so identifying the project, is it one tenement, is it more than one tenement, does it include a number of different operations that are in a similar area and are using similar infrastructure, or is it just each individual company with their own project? So these are some of the things that we'll need to work through as well. talked about valuations and the taxing point, and also modelling the impact on projects. And then down the track, there are going to be some accounting, tax reporting, systems requirements. How do you capture all the information necessary? So what is clear is that given we have a taxing point that is a new thing in terms of systems, it's not going to be the price that you sell the product at. It's going to be this notional, artificial point in the production process where you need to value the product. How do your systems capture that price on an ongoing basis? And how do your systems allocate deductible expenditure that's prior to the taxing point so that you can claim deductions for those, and then not deduct expenditure that is downstream of the taxing point? So there are some system things to work through ultimately down the track as well. It was interesting that one of the PTG group's recommendations was that all royalties, all state royalties, be creditable against the new taxes, and ultimately that was the recommendation and what the government accepted. It was interesting to see, I think just last week or the week before, the WA government decided to increase their royalties. So what that means is the WA government is going to get increased revenue from some of these projects, and that'll come straight out. It won't come from the mining companies, it'll come straight from the federal government, because it'll result in an increased credit against their MRAT liability, presuming those projects are in a sufficiently profitable position that they will be paying MRRT. So I think this is going to just create another point of difference between the federal and the state governments around that sort of vertical fiscal imbalance issue and how they raise their taxes. So there's some of the issues that venture or equity participants in projects will need to think about. Where you've got a joint venture, who's going to be paying the tax? Who owned the project at the 1st of May 2010 and therefore will get to have a starting base that they can deduct against the future cash flows from the project? Did you purchase your project or your tenement after the 1st of May 2010? What are your expenditures between that date and the 1st of July 2012? And how will you get to claim those? How do farm-ins work? So again, you may have one party who had an upfront or a deferred farming arrangement. What we've seen under the PRRT, which has been in place in offshore projects for a long time, what we've found because of the way that tax works is that you only get deductions for your expenditure if you actually have an interest in the project. So that has led to farming arrangements more commonly being upfront farm-ins. So you actually get your name on the title before you spend the expenditure or the exploration dollars, whereas quite often in the mining industry we see deferred farming arrangements that the title only transfers after the dollars have been spent. So we might see a change in preferences around those sorts of arrangements. As I said before, I guess valuation is one of the key things that you need to think about as at the 1st of May 2010. So if you did have a project, even if it's not going to be in production for 5 years, if you had a tenement at the 1st of May 2010, then you're entitled to work out the market value. If you choose to use market value as your starting base, you can work that out as at the 1st of May 2010, and that can be a future shield against future taxes. But it needs to be a contemporaneous valuation. So if you think about it, well, you know, what information did you have at the 1st of May? It's not a valuation now in hindsight. What was the technical information you had about the project at the 1st of May 2010? What were prices at that time? What was the general sense around the market of the value of projects? And so if you do nothing else, getting the documentation together that shows what was the status quo of your project at the 1st of May 2010 is critical, so that either now or in the future you can actually get a valuation done. One of the interesting interplays between the starting base and the taxing point is that because both of these taxes are looking to tax just the upstream activities, so the primary extraction of the resource, not the downstream processing, then when we're looking to put a market value on the resource, that's all we're valuing. We're just valuing the resource at that date, not the value of any downstream value add or infrastructure. And there's a bit of tension between wanting to get a higher starting base by effectively including more activities and value in the starting base prior to the taxing point, there's tension between that and wanting to have, going forward, a taxing point that's as close to the point of extraction as possible. So you need to think about, when you're working out your taxing point, what's into play with the starting base market value at the 1st of May 2010. And I guess I've mentioned this a couple of times, but this key issue around the taxing point, which is going to be different for each project. One of the industries that was really lobbying to be excluded completely from the tax was the magnetite industry. But the final recommendation that we have is that magnetite is in, so all iron ore is in the MRRT. But it's particularly difficult with magnetite to work out the value of the resource, because up until now we haven't really had DSO of magnetite, and so and we know there's a lot of downstream processing that needs to happen before this is in a marketable state. So how do we work out the value of magnetite after we've dug it out of the ground and stuck it on the ROM stockpile? It's not something we've had to do before, but we will need to do that. And the sense we're getting from the implementation group is that there won't be a lot of safe harbours, so there won't be sort of automatic calculations that allow you to just mechanically work it out. You're going to need to look at your project. What are your assets upstream, within the taxing point in the extraction process, and what are your assets downstream of the extraction process that you can leave out of the tax. The slide there talks about a few different methodologies that we actually see from an area called transfer pricing, which is where related parties internationally deal with their sister companies or parent companies overseas. Under income tax law, each tax office, whether it's the ATO and the Chinese tax authorities or the ATO and the US tax authorities, want to get their share of tax. And so what we've seen is develop a whole science around working out a market value or arm's length taxing point for a particular project when it leaves Australia. It's a similar concept in MRRT, that what we're trying to do is work out the price of something at an artificial point somewhere along the production line, and there's a whole science behind different methodologies we can use to work out that taxing point. And it really has regard to the economics of the project, both the upstream aspects and the downstream aspects. And advanced pricing agreements are where you might actually get an agreement with the tax office around your particular pricing method, and that will probably be a good way to go for many projects. I really talked about modelling and the fact that banks and more probably equity investors will want to know the impact of these taxes on your project in the short term, I think, before they make investments. Just briefly on the 50 million concession. So this is only for MRRT, not PRRT, and effectively it's been slightly expanded by the Policy Transition Group's recommendations so that it's going to phase in from 50 million to 100 million. So this is an annual profit-based threshold that if your project generates less than 50 million profits each year, you will not pay MRRT. But there are some downsides to using that concession, because if you later exceed that threshold and go into the tax, you won't get any starting base or any deductions for expenditure that you incurred while you're in that exempt sort of phase. So there's some, even if you're thinking, well, I'm not sure if a project's going to get above that threshold, it might be worth just looking at the different options you have, whether to sort of go into the tax with a basis and claim that, or to claim the exemption. It was pretty disappointing to see that there were no incentives around exploration, so no flow-through share scheme or even tax credit for exploration. We're still left with just the tax deductibility of exploration, which isn't terribly helpful when you've got a lot of tax losses as an early-stage exploration company. The Policy Transition Group has talked about further steps that need to be taken to develop policy around exploration and how to encourage exploration, but we don't have anything from a tax or a fiscal perspective at this stage, which was quite disappointing, I think. So what we're seeing and helping a lot of our clients to do is to put together a fairly detailed action plan for perhaps the next 12 to 18 months around how they're going to think about implementing their approach to minerals resource rent tax or petroleum resource rent tax. And there might be some short-term things they need to think about, as I mentioned, or there might be some more medium to long-term things. You don't need to do everything right now, but it is worth having a discussion, thinking about, well, what are the immediate steps we need to take just to understand at some level the impact on our project and how we communicate with the various stakeholders. How much time do I have left? 2 minutes. I'm happy to sort of take any questions if we have any in the last minute or two.
Yeah, any questions, anyone?
Down the front here. I think there's a mic coming around.
Is the tax department ready for this little tax?
Look, what we know about the tax department is they've got lots of people and they can throw lots of resources at these sorts of things. I think it'll still take them a long time to get up to speed. We're not really even at that point yet, so they're involved in the consultation process, but we still need the law to come through. Our experience at dealing with the tax office on petroleum resource rent tax is that once the law is in, their job is to enforce it and to do so in order to raise as much tax as possible. So really the time to be involved in consultation and getting the law right is in the drafting of the legislation, because you can't rely on the tax office to sort of interpret it favourably for business. So I'm not sure if that was an answer or not. Yeah, that's probably right. Maybe it was a diplomatic answer. Any others?
Any other questions?
Obviously, I didn't really go through the detail, and no doubt you have other opportunities to have presentations on the detail over the next year. So I'd like to also just thank Kerry for the opportunity to talk today and the organisers of the symposium, so we really appreciate the opportunity to be here. Also to Andrew Waskett and the Minotaur guys for hosting us down here, so thank you very much.
Thank you very much. Thank you very much, Sean and Angus. Our next speaker is Joe Mastrangelo. Let me get it right again, Joe. Excuse me. It's Joe Mastrangelo. Did I get that one right that time? Thank you, Joe. Just before, while Joe's coming up to the podium, Major General John Hartley just asked to pass on that if anyone would like a copy of his company's electronic products, he'd be happy to pass it on to you if you could give him his business card after the session, and he will be delighted to give you more information. Joe is he's currently the Director of the Resources and Energy Sector Infrastructure Council in South Australia. He's also a director of the major projects and investment attraction, which is a role within PIRSA that involves identifying and attracting investment opportunities to South Australia and providing case management services that facilitate complex multi-government interactions on behalf of the project proponents. And his key responsibility is facilitating investment within the resources sector. His presentation today will focus on RESIC's activities and the impetus that drives them, and what the council plans to deliver that supports South Australia's budgeting resources and energy sector to meet the future demands. Thank you, Joe.
Thank you for that kind introduction. I'll start off where Sean finished off by thanking Kerry for the opportunity, and the rest of the team, Anita, for picking me up at the airport. Thank you very much. And it's great to be here. It's always good to speak outside of metropolitan Adelaide and to have the opportunity to promote South Australia. Symposium, we put our names down for these talks many months ahead, and then the days passed very quickly, and I said, shit, it's here. Symposium, what does that word mean? So I go to Wikipedia, and it's an old ancient Greek term, and it means a gathering of people where they come and share information, have a drink, and so that's what we're going. We had the drink last night. That was pretty good. And here I'm going to just talk a little bit about South Australia as a whole, and I think you'll get a good feel for why we think it's a great investment destination for mineral and energy projects. I'm going to talk a little bit about RESIC and what we're doing in terms of infrastructure planning, how we're working with industry and across other government agencies. And then I'll touch on some activities that I think underpin the theme of the conference, which is future-proofing. So, South Australia, rich in resources, that's not our fault. We were born with those resources, and a lot of copper deposits, iron ore, mineral sands, with BHP Billiton, copper and uranium and so forth. So, very strong in those areas, and we've got Lee Creek with coal, and there's a lot of other coal deposits, and I'll just talk a little bit about that. So, where's the wealth? And I'll take you through slide by slide, just very, very quickly. And you'll see the green dots on the screen there. They're operating mines, and we are a relatively small state when you compare us to Western Australia and Queensland and New South Wales. But when you talk about world-class mines, I don't think you can go past the ones that we have, such as Prominent Hill and copper, and Olympic Dam with uranium and copper, and Iluka with its mineral sands deposit. So world-class mines. But there's those circles highlighted there represent other opportunities, and in copper, I think Hillside with Rex Minerals is the next big opportunity that you'll see coming through. Iron ore, and you've had some of those companies speak here today over the last few days, IMEX Resources and so forth, and Western Plain Group, who's brewing up a project to take their ore through Port Pirie. But we have a lot of junior miners, and Sean mentioned, or I think it was the previous speaker mentioned it about ports, and ports is a big issue. But we have a few options and opportunities moving forward, but lots of activity in the iron ore space. Uranium, well, we've got a couple of uranium deposits and mines, processing. Exporting uranium. Olympic Dam will be one of the largest, will be the largest mine on the world and the largest iron ore deposit in the world. So just in that, there's a whole, around that whole region and over to the eastern border with Honeymoon, a lot of uranium deposits, and we have a good half dozen junior uranium explorers. Heavy mineral sands, really just one play at the moment, but that green dot, which is just Jacinthia Ambrosia, which is the Iluka mine, $500 million mine that was commenced in late 2010. So, and there's a lot of prospectivity there. A lot of base metals around the state as well, and some operating mines, and more to come. Coal, Lee Creek, but I guess for the future, Altona Resources with its Akaringa project, a huge project, 10 billion barrels per annum that could come out of that project, and Link Energy is another large coal deposit project. Just moving not only minerals but a lot of onshore coal seam gas deposits and gas around Moomba. Shale gas, offshore, we've got a lot of deposits, a lot of projects coming through. And geothermal, you would have heard Terry Callis, I think yesterday, talk about his project at Paralana and how they're trying to feed, as part of their demonstration project, one of the uranium mines, and they're progressing that. And geodynamics have had their challenges. The whole sector really has had its challenges, but in terms of the GFC and capital coming out of that market. But I think once they're able to prove the technology and get some viable projects up, South Australia, have about 80% of the geothermal resource within the state. A significant part of the expenditure in that market happens within our state, and we think there's a big, bright future long term for geothermal. Some of the demand drivers, just quickly, this is courtesy of Flinders Ports, who are doing the Port Bonython project, and those bubbles you see there with India and China, they represent the size of the market, but as they go up that curve, it also represents how much iron ore per head of capital they'll use, and you'll see Australia's on the developed side with the UK and USA, but these two countries and others there as well, they have a phenomenal appetite for resources, and that'll just continue to grow as we move forward. Those dots represent operating uranium powered power plants. And there's a huge, even with the devastation we've had in Japan recently, there's still a big push for construction of reactors and so forth. So big market for uranium, and we do hold, I think, 13% of the world's uranium and about 40-45% of Australia's uranium in South Australia. And this is only going to improve with the Woomera Protected Area access that was approved recently by the Commonwealth Government. This is an interesting slide because it's about motor vehicles, and if America has something, I think 800 cars per head of capita, Korea is something like 600 cars per 1,000 head of capita. China at the moment has 40 cars per 1,000 head of capita. And when I turned 16, I knew what I wanted. I wanted a car. And if you understand what goes into making a car, there's a lot of alloys and metals and rare earths, and we have a lot of those deposits and those mines coming into South Australia. So big future for our industry. Just a few facts. Say 2002, 2003, we only had 4 mines, and that was Lee Creek, Challenger Gold Deposit, Olympic Dam, and one other. Beverley, the uranium mine. Thank you, Angus. So now we have 16 in a very short space of time, and still plenty of the others. The map on the left-hand side is our exploration licences. Still plenty of space there, and we have the whole Woomera Protected Area to go through, and that's the size of England in itself. That's our pipeline, that's our investment pipeline. So we have 16 operating mines that are shown on the top tier, about another 35 projects at different stages in their development cycle coming through that are hopefully, many of those will become operating mines, and then some 80 to 90 prospects at the bottom tier there, and they're at the early stages of exploration, but you can see South Australia is a very strong market for exploration activity that eventually feeds into the projects and then the operating mines. And that's largely driven by our PACE program, and I'll talk a little bit more about that. And you can see back in just before the GFC, we had about $300 million of expenditure in the mineral area for exploration. That's around about 170 million at the moment, but our target is 100 million at the moment, and we will increase that with the new strategic plan targets to 200 million per annum. As I mentioned, South Australia really punches well above its weight, and it's not commonly known out there, and that's why these events are very good for us to come out and just talk why we are so strong, in the sense that 31% of the national share, given that we only represent 8 or 9% of the state, we're 3 times that when it comes to exploration activity for both copper and uranium, and we are the second largest exporter of iron ore outside of Western Australia. So when you look at those things, we are a significant player, but not well known. This is a very telling slide, and this is why the resources sector for South Australia is very important. Minerals, if you go back, the slides would have been completely different, but minerals represents the $3 billion of exports out of the state. Some 36% of total exports comes from this sector. So we're heavily reliant on our economic prosperity on this sector, coming from a fairly low base of 13% just not long ago. So that's phenomenal growth, and we're coping with that growth. And we tell this story all over the world, Canada and China and India, and that's a photo of the previous minister, Minister Holloway, who was promoting our story in China and China Mining in 2010. So we'll continue to do that. And we are going back, and we do a lot of travel overseas. Just to show, that's some 13, 14 different Chinese companies that have already seen the opportunity in South Australia very early and joint venturing and partnering with some of the companies that you have heard here today. So, they have seen, they say they've seen it early, and they've recognised South Australia as an investment destination, and that'll just continue to grow as time goes on. And it's very exciting what we heard the other day about the Braemar province and how that might be able to come through to South Australia and the benefits that'll bring to the companies and to the state. So I was surprised. This is a term that the Chinese gave us, and I put the slide there. The new mining frontier, and I noticed on some documentation with New South Wales that they are the mining frontier, but we are the new one, so we could be the new one. But very much the theme and the story that people are telling us around the world, it's new to them, and they do see opportunities. Again, you might say that the drivers have created the opportunity, but I just wanted to mention that in 2004 the state government saw the potential, and as part of its strategic plan, it said it wanted this to be a cornerstone sector for our state, and I think it's set the targets and put the initiatives in place to make it really progress. But it's not just us saying that we're the new frontier. Access Economics through Deloitte has said that you can read there, to be a global titan. The Fraser Institute also rates us in the top 10 jurisdictions around the world for investment. Don't rate so highly around infrastructure, but we're working on that. $1.4 billion of exploration investment since 2002, over the last 9-10 years. Again, represent 35% of the total exports of the state, and so on. We're going for time. Good. Future-proofing. Exclusive process of trying to anticipate future developments so that actions can be taken to minimise possible negative consequences and to seize opportunities. So the negative consequences from my perspective is limiting investment flow. And we all understand and we've heard that both skills development, resources, and having human capital and infrastructure are the two main inhibitors and enablers. So there's just some guiding principles, encouraging exploration, identifying new markets in our investment attraction, facilitating collaboration and so forth. And so, to future-proof, we believe that you need to be implementing some of these guiding principles. And 2.5 years ago, the government saw a need prior to the GFC, with all the exploration expenditure around the $300 million mark, that would translate into mining opportunities, but infrastructure would be an issue that it needed to get its head around what was needed, what was out there, what was needed, and what levers it could pull, and what policy it could develop, and how it could work with the industry to help foresee and anticipate what the needs were and to bring that into fruition. So to establish RESIC, and one of my roles is the director of RESIC. It's a very high-level council, doesn't have a lot of actual staff, but the council is represented by the leading economic development agencies, the CEOs, and also private sector. And we have Dean Della Valle from BHP Billiton, and Jim White from Centrex, who's a junior miner, iron ore miner that came from One Steel, and Tino, who headed up Stewart Petroleum, just been bought out by Cenex, and Lou Owens, who was the CEO of Electronet, the local the electricity maintenance organisation in South Australia, and Jason and John, who are both the president and CEO of our leading industry association, SECOMI, reports directly through the chair, who's the head of Aluka in South Australia, Hans Umlauf, to the Minister for Infrastructure, and works very closely with the Minister, Tom Kitson-Tonis, the Minister of Mineral Resource Development. And small team, myself and Sue really work on it, and we draw the resources in from the range of government departments that we interface with. Really our sort of success statement is to provide advice to the government that it takes on board to see the sector move ahead. We do basically three things. We capture knowledge and data, and we try to make that available to industry. We try to bring industry together to work better closely together through collaborative partnerships and work with government. And we also provide that direct advice to government on a holistic state perspective on infrastructure policy and planning. One of our key projects is the development of infrastructure. So this is one way of us collecting information, putting it into a GIS system, web-based, and making that available to industry and to government. And that involves understanding what's there. So we're doing that through an audit process, working with private sector infrastructure providers such as Electronet, Telstra and ETSA Utilities and so forth, and the gas providers, and working with all the government departments that look after the ports and the roads and the rail systems and so forth. So we're working private and public to draw this information and make it available through a channel. We're undertaking an infrastructure demand study, and I'll talk a little bit more about that. And we're parking this information in what's called SARIC. And SARIC's a geophysical, geotechnical database that provides a lot of useful information to explorers and mining companies, but it's very light on in infrastructure. So we want to populate that and get that to leverage collaboration within industry and to facilitate further investment. Now, so this is a little video we put together. It sort of gives, this is not live yet, this is a working in progress. And so you'll go to a website and, for example, you'll click on a mine and you'll have all the details of that mine. And if you want further information, you'll go to in this case, Aluka's website to get further information. So if you're want to know more about the industry, this is one way of doing it. If you're looking at developing some exploration activity or a mine near a mine, this will become useful as we go along. This is about 5 minutes. So you can find very quickly at your computer, at your desk, anywhere in the world, about projects in South Australia. But this is slanted towards infrastructure, and we'll come to that in a minute. So again, Prominent Hill, you'll get all the details of it. You'll go down, and this now will click into the metadata, because the geotechnical, the savvy IT people say the metadata is very important to know that it's of credibility and the integrity of the data. So then over on the left-hand side, you start to open layers, and you pick up, a town, for example, and that's Roxby Downs, and we're going to populate that with demographic data and the competencies of that regions, and if it's got a university or what skill sets it's got. So you'll be able to pick up this and population base and so forth. All this demographic data, all in one point. And then we go further, and we have 400 airstrips in the state owned by local council, the government, and pastoral flying doctors, and you'll know where those airstrips are, whether they're sealed, unsealed, manned, unmanned, what sort of planes can be landed there. And this all helps in the pre-feasibility study when you're looking to establish a mine. And this drop-down menu, it gives you the details that you need. Again, it goes over now, and I think we're going to pick up MPLs, miscellaneous purpose licence. For example, mining companies have private infrastructure, whether it being a water pipeline, a transmission line, a rail line, and this enables you to find out what's there and an opportunity to see if there's any spare capacity in that infrastructure to utilise it for your operations. So very important. Previously, to find this type of information, you would have been, I don't want to say what you'd be doing, but you'd be going crazy. Again, we pick up rail and road, and you get to understand what track. We have 3 different gauges and many different private sector owners, and you get all this information on the tip of your finger at hand, knowing who's the operator, what gauge it is, what track speeds, and a contact point to make the knowledge of infrastructure and who runs it and who owns it much more accessible than it's been in the past. You're able to zoom up and you're able to download this information. So if you're building reports and reporting to the ASX, you can actually use this to report on your infrastructure components of your reports. This is Port Lincoln, and it tells you it has 8 different berths, and it tells you what berths are being used for what the water depths are, what sort of vessels are able to go into that port, and again, a contact number for the port operator. So, as you can see, you'll have all the information about mines, towns, private sector infrastructure, public sector infrastructure, contact points at your computer desk. So, this is the last bit, and this shows a little tool as well that we've built in. That if you want to know the length of something, you can go from point A to point B, and it'll tell you how many kilometres, how many metres, and so forth. So you can use it for that feasibility planning. This is the first time I've shown this out, and it was something we put together just to demonstrate where we're heading with it. And this will go live hopefully by about July, August this year with the information that we do have available. Then we'll work with industry and try to understand what works well, what doesn't work well, and then keep refining the system. And this is that little tool for measuring how long pipeline might be, or if you're going point A to point B. So, just to continue, infrastructure demand study, that triangle that I showed you previously, all those projects, those companies that are managing those projects are going to be surveyed, 100 questions, both the quantitative and qualitative type questions. We're going to the oil and gas and geothermal sector and infrastructure providers to get a good understanding of what's needed, when it's needed, to look at where we might be able to see some opportunities for investment or collaboration, we spoke about an infrastructure corridor. So where is that corridor needed, when is it needed, and who will need it? So that we'll be in a position to inform government on maybe looking at ways that we can zone a corridor for infrastructure based on some understanding of what the market demands are. But again, this information will have demand maps representing the different companies on power, water, rail, road, what they need. So companies will be able to see on the computer, on through the system, SAREC system, where some synergies may lie. So we feel that's very important. Just a little bit about future-proofing. And I won't cover all of them, but I'll just, with the time that we've got left, we'll talk a little bit about how we're working with many, many stakeholders to ensure that we're doing the planning to see infrastructure put in place. Now this is a little Wingalina on the border of Western Australia, near the border of Northern Territory on the left there. They have a nickel cobalt mine proposal, $3.2 billion, mine life about 20 years, but the issue there is there's no infrastructure. So we're working with the company, trying to identify some solutions. They have a budget for a road. They can go out west, they can go through the Lassiter Highway into through the NT, but we believe that a good option for them is to go through the APY lands and connect into the rail line that goes up to Darwin. So we're working on that with them on that. And if you can just appreciate what road infrastructure would do to that whole area. PIRSA, the department that I work with, has undertaken a prospectivity analysis, and it's very prospective region, but no infrastructure. So if we're able to work with a company around a big project and get some infrastructure up there and work with the Commonwealth Government, then we believe this will, bring great opportunity to the state and to that region, and good for regional South Australia, create a lot of jobs and a better accessibility. Ports. Well, these are just some of the ports that are the new ports. We do have 10 other, we have, I think, 10 ports operated by Flinders Ports and Viterra. But these are some new ones up there like Sheeps Hill and Lucky Bay and Port Lincoln. If you do understand the port situation, you'll see that the existing ports all are around highly residential areas, whether it be in Outer Harbour, Port Pirie, Port Lincoln. Port Lincoln, they all have challenges. Port Lincoln shared with the grain and the seafood industry, and there's a 2-day turnaround, and they've got provisional, Centris have got provisional approval to use Port Lincoln, but they've decided to go to Sheeps Hill. One still are looking at what they might do with their wharf. I've been very close to the Spencer Gulf Port Link Consortium that are looking at a huge port, and I've got some slides there. And you've heard Western Plains Group in the paper, they're brewing up a project, or they've got approval to go through Port Pirie. What I'm trying to say there is that irrespective of the need for a deep sea water port, companies are finding solutions. But obviously, to get the critical mass, to get the economies of scale, we do need Cape-sized vessels, and we've been working with the consortium, and they have got approval to go to. They have taken up the option for the exclusivity period to do a bankable feasibility study, a $700 million port at Port Bonython near the Santos jetty, deep water. We've got issues there in terms of environmental considerations and concerns with the cuttlefish, and they'll be dealt with through that EIS process. That's what it will look like. That was provided by Leighton's. And they've also, in the interim, you heard from IMX, and you've seen, the retainer system. That's to load 2 Panamax vessels at Outer Harbour. So, these things are all happening, and you would have seen something like this maybe yesterday. So direct into the hull, reduces dust and debris and so forth. So Lucky Bay, that's a transshipment barging option from the coast near on the Eyre Peninsula, and that's very new, and hopefully we'll see something like that come through. Port Bonython is a strategic piece of land, and we spoke about the unconventional gas market, and we're looking at what's needed to create an LNG facility in that location. Port Bonython's there, the jetty. We've got Port Bonython Fuels. You have the ammonium nitrate plant. So a very strategic piece of land that the government has put aside for servicing the resources sector. Very quickly, renewable energy. It's big in South Australia. We have solar, geothermal, wind potential. Huge growth over the next, foreseeable years there, next up to 2030. Close to 13,000 megawatts of power could come on the market if it, if all these stars align and if the technology is developed. But if that was the case, what would we do with that power? South Australia can't consume it. So we did some modelling with a group of people, and we found that at about 2014 we need peaking plants, and about 2023 we need to get that power that we're generating out of the state. And through scenario planning and modelling and a team of experts around the table, under Electronet sort of auspices, we came up with a footprint for the future for augmentation for the South Australian network that involves picking up, where you see those circles, renewable energy and feeding them into the grid and getting that power outside of South Australia. Rail, we haven't done a lot of work on rail, but we have spent $45 million on the Eyre Peninsula, upgrading that, but a lot more work needs to go into that area if we're going to service those junior miners and get them access to some of those ports that you saw mentioned previously. SCT, they announced the other day that they're doing a freight terminal again to help the mining industry, and that it's a big project, and containers to be held there, and that'll improve the efficiencies of some of the ports, but again some work happening in that area. And a lot of money's been spent diverting the traffic away from Port Adelaide, the tourist area, into through to Outer Harbour by the first opening rail bridges and so forth. So hundreds of millions of dollars have been spent there. I'll skip through this. It's the round table. We have got a strong emerging coal seam gas, unconventional gas market. It's really at the early stages, but this group that is represented by 40 participants, a lot of them from private sector, around the table looking at how do they collectively collaborate to access new markets, to develop supply chains, to stimulate technology development, to attract investment and so on, and how, water in terms of water sustainability. So these common problems, we're saying what we're trying to do in South Australia is not for companies to work individually, but collectively together, where it's pre-competitive initiatives that they do come together and work on and try to bring them forward. We're working very closely with the Eyre Peninsula Mining Alliance, and they represent five companies in that area, very similar to the Braemar Province alliance that was announced the other day by Minotaur. Again, RESIC wants to work with these groups, undertaking the infrastructure demand study, looking at other initiatives, working closely with industry and infrastructure providers and with the government to help facilitate the outcomes that they're looking for. I'm responsible at the moment for writing the mineral and energy chapter for the new infrastructure plan for South Australia. And when I say responsible, working across government agencies and within my own agency, and it's the first time that a sector, an industry sector, has been included. That's the prominence that the resources sector has within South Australia and with the government. But this mud map really points out what I've been through and where the hotspots are. And you've got the Wingalina project and the APY lands up on the western northern border there. You've got potentially the Arafura project coming in from the north, and getting that rare earths processing plant in Whyalla going. You have continued growth of Prominent Hill there with the underground expansion, and with the Olympic Dam going out north and south to infrastructure, ports and so forth. You have the Eyre Peninsula region with a lot of iron ore junior miners looking for port solutions to export their products. And then on the right-hand side there on the eastern border, you have the Braemar Province. They're the areas that the state and the department will be focusing on. Not saying that others aren't important, but I think this is the message that we're trying to get through, is that we have got some key areas that we can bring some opportunity to. This is the infrastructure plan for South Australia, and it's currently being revised. It was written in 2005. It's 5 years on, so we're re-looking at that, and I might leave my presentation there, given that we're very close to the end.
All right.
Yeah, thank you.
Thank you. I think we've got a bit of spare time.
Yeah, because I'm looking at my watch.
Right. Well, I think we've got a few more minutes left, so if there's
I've
any
got a few
questions or
slides to go if it's okay with the... Great. PACE 2020. Basically, PACE 2020 is about increasing the level of exploration in South Australia. It's a funding mechanism that provides to explorers a subsidy to do exploration drilling. The infrastructure channel is funded out of this program also, and there's a whole range of initiatives that this program provides in terms of making information available to industry. RESA, these are just things that we're involved with and we support. RESA is the Resources Engineering Skills Alliance, and runs a whole range of programs in terms of upskilling Indigenous, and RESA is working very closely with Iluka and Oz Minerals and BHP Billiton in terms of their training programs and so forth. SECOMI, keeping geologists in the state. Again, themes of future-proofing. You know, if we don't have good geologists, we don't retain the best people within South Australia, you know, we'll be at a disadvantage. So there's 20 geologists participating in this, and they subsidise their salaries and so forth to keep them here. Digging Deep is a social inclusion initiative about working with mining companies to put something back into the community that they operate in. And the inaugural award was given to, I believe, Oz Mineral Resources for their work that they've done around Prominent Hill. Richard Hillis was speaking here again. You know, developing technology, and you would have heard about the CRC Deep Exploration Technology, and that's based in South Australia, and that's a national CRC. The Mining Act. You know, we talked to some colleagues here. There's parts of it they like. There's parts of it they don't like. One part they don't like, I heard yesterday from one of my colleagues saying that we have to pay $500 to farmers in order for them to get some legal advice on how we can how we can engage with the mining companies. So they don't like that. But this is all about trying to improve the processes to make it easier for industry. We don't always get it right. So if there are things that things that are going to be put up, certainly pass on your thoughts to me, and I can pass them on. But again, changes to the Mining Act to make things fly a lot smoother and faster. Case management. I'm a case manager, and for example, when international companies come in, or a company that comes in from interstate needs to work with government departments for the approval of its project, it's mind-boggling. You know, there's a lot of wheel spinning, there's a lot of language that's used that's not understood, there's a lot of procedures, processes, regulations that aren't understood. We get in early with the company, bring all the regulating organisations like the Department of Environment and Heritage, EPA, the Department of Planning and Local Government, and all the key stakeholders to find out early what the barriers are, where the deal breakers might be. So we're able to fast track that learning and make sure the interpretation of and the translation of what government talk is understood by the private sector. Strategic plan is being upgraded, and this really drives all government departments in terms of its targets and where its focus should be, and its interface with industry. And that's my details, and that's about it. Thank you.
Thank you, Joe. And I think we do have a couple of minutes left, so I'm glad you're able to finish off, because it was interesting what you had.
45 minutes is not a usual time slot, so I wasn't sure. Yeah.
Well done. Is there any questions from anyone? Maybe just, I have one brief one, that interactive model that you've developed. Where will that become available? Is it through the PIRSA website? Or?
It's through the PIRSA website. If you go to the PIRSA website, you'll see a tag SARIG, and you click into SARIG, and then you'll have another button that says Infrastructure Channel, and then from there you'll be able to interrogate that. But that is not live yet. That's still under development. The revised SARIG was launched in May this month, and will hopefully go on July, as I said, about July, August. Yeah.
Good. Thank you. Any other questions? Well, thank you very much, and perhaps we could please put our hands together for all the speakers this morning. And well done. Thank you.
Thank you.